Okay, morning. So today's lecture is on investment appraisal. So the purpose why we are studying this lecture is to evaluate projects. Okay, so in real life, a business would have to evaluate investment opportunities that come their way. So in evaluating these investments, we have a few tools, as in a few methods, approaches. That is a calculation bit for this topic. Okay, so the investment that we're talking about, these amounts are of course coming in the future, and when we put in our capital, that is called the initial sum or initial capital or the initial investment. It's also referred to as initial outlay. Okay, so and generally the rule is this: any investment is not worthwhile if you cannot even recover the initial capital, right? Or if it does not produce a reasonable rate of return on the capital invested. So the objectives of capital investment appraisal is to determine which specific investment projects the business should accept, because sometimes you'll be given more than one investments, and due to limited amount of funds, we can only choose one. So which is the best one that we can choose, that we should choose, sorry. Okay, so the total amount of capital expenditure in which the business should undertake. So sometimes the investment comes in the form of capital expenditure, as in we need to invest in new non-current assets. Okay, right. And then we also look at how the portfolio of projects should be financed, as in where are we going to get the funds to invest into these projects. Okay, now factors to be considered when using capital investment techniques is timing of cash flow. So when we invest now, today, in future, we will receive the cash flows, right? So when the timing of the cash flows are very important, okay? So for example, the question will tell you that it's maybe, for example, 3 or 4 years project. So the amounts and when they appear is crucial. I mean, it will be best if most of the amounts appear in the earliest years so that you recover your capital as soon as possible. Okay, so capital is always at year 0. I'll show you this later in a while. But for example, when you have a 5-year project, we need to work our figures starting from year 0, year 1, year 2, year 3, year 4, year 5, for example. So capital is where we place, it's a cash outflow, which we place in year 0. Year 0 means now, at this moment in time. Okay. So cash flows is where cash is received. Okay. The cash inflows, that is. So cash inflow means money coming in. Cash outflow means money going out. Similar to what you studied in statement of cash flows. Okay. Okay. Then another important element here in this topic is called the cost of capital, as in the interest rate. So you need to detect this element in a question in order to do the computations correctly. Okay. Residual value of asset. Okay, this one has now recently been scrapped off the syllabus, so I'll ignore this part. Okay. Life of competing projects. So the whole life of competing projects has to be considered during the appraisal. Reason because the duration of the project is also important, because when we invest in a long-term project and it takes like many years, then the investment will be deemed risky. We would probably expect a higher rate of return. Okay. Now, getting to the most important part of this chapter, the calculation part. So to evaluate capital projects, investment appraisal, these are the methods that you have to know. Okay. Payback period method, accounting rate of return method, net present value method, and internal rate of return method. Okay, so let's look at the first one, payback period method. So the payback period method measures how long it takes for us to recover just our initial investment. So we're not looking at profit. How long does it take the business to recover the capital? So when you're comparing 2 or more projects, the project with a shorter payback period, meaning capital can be recovered faster, is the better one. So an example is shown here. So calculate the payback period for the two projects. Okay, so what do we do for this example? We are trying to evaluate between project A and project B. So the capital that we need to invest in project A is 12,000. In project B, it's also 12,000. Okay, but you see the pattern of cash flow is different, right? So to calculate payback, let's do it for project A. We want to see how long it takes to recover just the initial investment, which is 12,000 in this case. So year one, we are recovering 5,000. Okay, so we put the 5,000. Now we need to see this as an accumulated basis. Okay, so year two, wait a minute. Okay, year two, we are recovering 4,000. So which means at the end of year two, we would have recovered an accumulated of 9,000. Yeah, so we would write it like that, 9,000. Okay, and year three, we are recovering 3,000. So at the end of year three, we would have recovered an accumulated figure of 12,000, okay, which is exactly the capital. So we say that for project A, it takes 3 years to recover the initial investment. Now let's do the same for project B. Project B, the initial investment is 12,000. So at the end of first year, we have recovered 2,000. At the end of second year, we have recovered 3,000. So altogether, we have recovered an accumulative amount of 5,000. At the end of year three, we would have recovered another 3,000. So that's a cumulative amount of 8,000. And at the end of year four, we have recovered an additional 4,000. So that's a cumulative amount of 12,000. So once you reach 12,000, we don't need to go beyond that. So as you can see, it takes 3 years to recover the investment for project A and 4 years to recover the investment for project B. So the payback period for project A is 3 years and for project B is 4 years. So in terms of payback period method, project A is a better project because we can recover the investment faster. Okay, so the same, you can try example 2 later. Now, the uses of payback period. So payback period can help in deciding whether to accept or reject the project, as it is one of the tools of investment appraisal. So the decision rule would depend on how long it takes. As I said just now, the project with the lesser payback period timing is the better one. Okay. So it can be used in ranking decisions, right? That means if you have to choose between 2 or more projects, you can list down all the payback periods across the projects and choose the best one, as in the one with the lowest payback period method. Okay. So it is also used in choosing a project when the future is unpredictable. Therefore, it's important to recover the initial investment quickly. So now, if you're walking into the future, which is quite uncertain, and you have to do investment appraisal for projects, this is where payback period becomes useful, because in payback period, we are almost minimizing the risk. We are just concerned about collecting the capital. So it is highly unlikely that we would run into a loss if you select the payback period method. Okay, so the advantages of payback period method, it's simple, it's easy to calculate. Okay, and it is particularly useful for companies with low cash balance, companies which cannot afford to risk money into projects. And it focuses on quick recovery of the capital of the project. Okay, reduces the chances of non-current assets becoming obsolete, because when the projects when non-current assets are not put to work for so long, then they will become obsolete. Okay, or if you stay long in a project, because payback period doesn't wait for the entire duration of the project. It focuses on just recovering the capital. Yep. So choosing projects with the shortest payback period would tend to minimize risk, as I mentioned just now. However, the disadvantages of payback period method is that it ignores a very important element in real life finance, which is time value of money. Money weakens over time. And the payback period method ignores all whatever happens after the capital is being received. So for example, uh, going back to these two projects, now, so by using payback period method, project A is a better one. But let's assume that after the third year, the cash flow here is 20,000, for example. But project B, let's assume it's, say, a huge amount, 80,000. So payback period is blinded towards what happens after the capital is recovered. If you go by payback period method, strictly you should choose project A. But then if you know that, or rather if you estimate that 1 year later, we're going to recover, we expect to recover $20,000 cash inflow and $80,000, I think it's better to go for project B. You know, because it takes a little longer, but you get a huge amount after on the fifth year. If you wait for 2 more years extra, you get a huge amount. Okay. Payback period cannot distinguish between projects having the same payback period. For example, I can switch the pattern and still come to, okay, for example, let's look at this. So now, if you base on payback period method, project A is the better one, right? But let's see this. Let's say project A, it takes, we're going to recover 500 in year 1, for example. I'm changing the question. And 1,000 in year 2. And 10,500 in year 3. So at the end of the 3 years here, you see, I take, assuming this is not the accumulated figure, this is the yearly inflow. So it takes 3 years to recover the capital, yes. But if I change the cash flow for project B to be like this, say 8,000, sorry, 500. Okay. Okay, coming back to the same situation, it takes 3 years to recover 12,000 for project A and 4 years to recover 12,000 for project B. So going by the payback period method, project A is a better project. But look at the pattern of cash flow. The amount in the earlier years is smaller and the amounts get larger as the years go by. But if you look at project B, in the first year itself, you're recovering what? 8 over 12? It's like like 67%. Okay, so although project B takes a longer time to collect the investment, but the pattern of cash flow is less risky. So payback period is blinded towards these facts. Okay, and does not consider lifetime of the project. So we need to also pay attention to lifetime of the project to determine the profit. So disadvantages of payback period is this: it does not focus on profit. Of course, yes, we want to minimize our risk, but at the end of the day, we also want some profit. Yeah, so no indication given on profitability of projects. Okay, it restricts firms from investing money in long-term projects. So all these are the disadvantages of payback period. Okay, so now let's look at the next method, accounting rate of return. So in accounting rate of return, we are trying to calculate the percentage rate of return of investing in a project. So this is the formula: average annual profits divide average investments times 100%. Okay. Now, to get the average annual profit, this is the formula. Additional revenue minus additional costs over number of years. Now, why did I use the word additional here? Because in this chapter, only, well, it works the same as decision making. Okay, we only consider relevant cash flows such as revenue that we're going to get if you go for the project and expense that we're going to incur if you go for the project. Okay, so additional revenue minus additional costs divide number of years. So this will give us the numerator. As for the denominator, the formula is initial investment plus scrap value over 2 plus working capital increase. Now, as I mentioned just now, of late, the past 2 sittings, this scrap value has been removed in the syllabus, but then most of the questions has this element, so I just leave it there. Okay, it's not a very difficult thing to learn. It's just that it's not tested anymore. Okay, so initial investment plus scrap value over 2. So this particularly applies when we are trying to invest in a non-current asset. So when you don't want the non-current asset at the end of the project, we can sell it. That's the scrap value we're talking about. Okay. As for this one, this element is quite rare. Even if it comes out, it'll be given directly to you. Working capital increase, a figure, you just put a figure. If the figure is positive, then you add. If they say working capital decrease, then you minus. But among all the past years, if I'm not mistaken, there's only 2 years where they asked this, and it was in the many years back. Okay. All right. So, example, you got a short example here. Initial investment for project X is 6,500. Project X duration 20 years. Cash flows per year is 1,000. And then depreciation per year, straight line, is $325. So for project Y, you see the same figures. Okay. Now, if you were to calculate the ARR for project X, average annual profit, okay, its cash flow is 1,000 per year for 20 years. So 1 times 20,000, so that's how I get 20,000 minus, you see, you're depreciating 325 per year for 20 years. So which means 325 times 20 is 6,500. Okay, so this is the only method where we take into account everything including non-cash items, right? So 20,000 minus 6,500 divided by 20 will give us the average profit. Okay, average investment is following the formula, half initial investment plus scrap value. So here there is no mention of scrap value, so we take it as 0. So then you will get 20.77%. Okay, so doing the same for project Y, we will get 12.89%. So comparing these two, we will get a higher return in investing in X. So if you use the ARR method, project X is the better project to invest in because it has a higher accounting rate of return. So earlier, the payback period method, the lower the figure, the better it is. So here, under the ARR method, the higher the percentage, the better it is. Okay, so advantages of ARR, accounting rate of return method. It's easy to use, simple to calculate, right? It takes into account everything including non-cash items. It's a relevant measure of success because we are focusing on profit here. Okay, but disadvantages would be the average annual profits may not be the same every year, right? And it ignores timing of cash flow. That means we are looking at it as a total. No? So we are not paying particular attention to timing of cash flow, as in, like I mentioned just now, it's best if the highest amount comes in the earlier year. So that is not taken into account here. Okay. And like payback period method, this method cannot differentiate between two projects with the same average profit, but different timing of cash flow. Okay. No, there's no commonly accepted method of calculating capital employed. I mean, depending on the type of business, different businesses might have their own method. And it ignores the duration of the project because duration of the project is also important because if you invest in a project too long, then we would require, it's more risky, so we would require a higher percentage rate of return. Okay, then the third method is called the net present value method. So under this method, yeah, under this method, what we are trying to do is we are trying to convert future cash flow to what they are worth today. I repeat, we're trying to convert future cash flow to what they are worth today. So, because, for example, 1,000 in 3 years' time is not equal to 1,000 today, is right? So this process of converting future cash flow to what it's worth today is called discounting the cash flows. Okay, so for this, well, this is the only method where time value of money is considered. So to discount the cash flow, the question needs to tell you the interest rate or rather the cost of capital. Okay, so here's an example. So the following cash flows have been estimated for a project. So this is a 5-year project. Okay, in year 0. So whatever you see in year 0 means the capital. And it's always in brackets because we put in capital, that's a cash flow. Sorry, that's a cash outflow from the business point of view. So for this project, we're investing 2,000 and we expect to collect these amounts over the years. So calculate the NPV of the project and state whether the project is acceptable, assuming that the cost of capital is 10%. So the question will give you what is this figure? This is called a discount factor. Okay. So all we need to do is multiply the future cash flows with the discount factor in the correct year. Okay. And we will get the amount. So when you get the amount, that's called a present value, we total it up and we deduct the capital and we get what is called the net present value. Okay, so to illustrate this, I will demonstrate a question. Question 1. This is taken from a past year. So Clark is replacing one of his machines. He can choose between machine A or machine B. So details of the machines are as follows. So here, this is an investment decision of whether to invest in machine A or machine B. So for machine A, the cost is 80,000, which means the cost of the machine is the capital of the project. Okay, 80,000. Machine A can be used for 4 years. At the end of 4 years, we expect to sell machine A for 4,000. And the depreciation for each machine is straight line. Okay, so as you have learned before, to calculate the straight line, to calculate the depreciation per year, it's 80,000 minus 4,000 and divide by 4. Okay, and then we're also given for both machines, the estimated receipts and payments. And then here, this is the cost of capital, 10%, as in the interest rate. And we are given the discount factor. So since they've mentioned that the cost of capital is 10%, okay, you ignore the 20% first because this one relates to another method, which, remember, there are 4 methods, right? There are 4 methods. So I've talked about payback period, I've talked about accounting rate of return method, and I am talking about this method now. The other percentage relates to this method, which I have not talked about. Okay, so hang on to that. Okay, so well, calculate the accounting rate of return for each machine. So here's the answer. Let's do it for machine A. So we need to calculate average annual profit. So in order to do that, we need to calculate the profit for the 4 years. Okay, so in order to calculate the profit for the 4 years, total receipts is 316,000. So how do I get that? Is I add up these 4 figures. Okay, adding these 4 figures will give me 316,000. And then I deduct the total cash payments. These 4 figures. So that would be 184,000. And then I need to deduct depreciation because these two elements are cash elements. I need to also take into account the non-cash expense. So the depreciation is 76,000. Okay, how do I get that? Because the cost of the machine is 80,000. And at the end of 4 years, we can sell it for 4,000. So the depreciable amount is 80 minus 4,000, hence 76,000. So therefore, the profit is 56,000 and average annual profit. So 56 divided by 4 years is a 4-year project. So that's how we get the average annual profit to be 14,000. As for the average investment, okay, follow the formula, half into initial investment plus scrap value. Okay, there's no working capital increase for this question. So initial investment will be 80,000. Okay, I put it here. Initial investment plus scrap value divided by 2. So that's 42,000. Then we just apply the formula. Average annual profit over average investment times 100%. So that will give us 33.33%. Okay, so doing the same for machine B. So machine B, the total receipts would be this total payment, these 4 figures, and then total depreciation for 4 years is 100 minus 8, so that's 92,000. So the average annual profit is 41,000. Sorry, the total profit is 41,000. So 41,000 we need to divide by 4 years. So the average annual profit is 10.25. So the average investment using the same formula, the initial investment plus scrap value divided by 2, and then putting the formula. So we get the answer. So using the accounting rate of return, we get a higher rate of return from machine A as compared to machine B. So using the ARR method, machine A is a better project to invest as compared to machine B. We calculate the payback period for each machine. So then again, for machine A, so remember machine A, the investment amount is 80,000. So we are trying to calculate how long it takes to calculate to recover 80,000. So what we need to do is we list down the receipts, list down the payments, and you subtract them to get the net receipts. And just to remind you, in payback period method, we take into account only cash flow items. We do not include non-cash items such as depreciation. Okay, so the cash items are, the net receipts are this much. Now, for project machine A, at the end of year 1, we have recovered 35,000. At the end of year 2, we have recovered 33,000. So this is a total of 68,000. So we need a balance of 12,000 to recover 80,000. So that 12,000 is included in the third year, included in the 32,000. So it takes 2 full years plus 12 over 32 times 12. So whenever the balance of the capital is recovered in the coming year, you take the balance amount over the net cash flow in that year and times 12. So you will get 2 years and 5 months. Okay. Please ignore discounted payback period because it has been removed from the syllabus. Okay. So we do the same for machine B. So machine B, the investment is 100,000. So we list down the receipts, payments, net receipts. So it's based on the net receipts that you calculate. So 28 plus 41, that's 69. 69, you need another 31 to reach 100. So that 31 is included in this 33. So it takes 2 years plus the balance over the cash flow in the year times 12. So this is the answer. So in terms of payback period method, it is better to go for machine A as compared to machine B. Okay, next, calculate the net present value of each machine. All right. So to calculate the net present value, okay, we do it for machine A. So for machine A, this is the capital in the first year. Okay. Then you list down the net receipts. So since the interest rate, or rather the cost of capital is 10%, we follow the discount factors given for 10%. So you copy them and you multiply these figures. So when you multiply these figures, you will get these figures. So these are called the present value. So total present value minus initial investment, this is called the net present value. So if you base on the net present value method, we should accept a project if the net present value is greater than zero. Greater than zero. Okay, because if the net present value is negative, that means we would get a loss. Okay? And if you're comparing between two or more projects, the project with a higher net present value is the better project. So in terms of net present value, the higher the figure, the better it is. So doing the same for machine B, we list down the receipts, payments, and net receipts. So we put in the discount factor, so multiply. So we will get these figures, total them up, and deduct 100. So the net present value for machine B is 10,738. So if we use the net present value method, again, machine A is better than machine B. Okay, I hope that clarifies. Now, the last method is IRR, internal rate of return method. Okay, in this method, internal rate of return method, what we are trying to do is we are trying to calculate the interest rate that will give us net present value of 0. So as you can see from the graph here, the y-axis represents net present value, the x-axis represents interest rate. So the higher the interest rate, the higher the cost of capital, so the lower the NPV. So in IRR, we are trying to calculate this point here. What is the interest rate which causes NPV to be 0? Okay, so let's see. Going back to this question. Sorry, hang on. This is the formula. So in order to use the IRR method, we need to calculate 4 elements. Okay, the 4 elements are, well, I call it cap small a. Small a is the lower interest rate. Small b is the higher interest rate. Okay, and then capital A is the NPV at the lower interest rate. And capital B is the NPV at the highest interest rate. So this is the formula. Now take a look at the formula. Be careful, sometimes B itself will be negative, so it becomes A minus negative B, so A plus B. So you calculate accordingly. So this is the formula, small a plus capital A over capital A minus capital B times small b minus small a, as in the lower interest rate plus the NPV at the lower interest rate over the NPV at the lower interest rate minus the NPV at the higher interest rate times the difference in the interest rates. Okay, let's do it for this question. So if we were to calculate the IRR, okay, so we need to, you see, we've already got the NPV for, we already got the NPV for each machine. It's 27,693 for project A, sorry, machine A, and 10,738 for machine B. Okay, so this is worked out at 10%. So now we need to do the same at 20%. Okay, so all we need to do is change these figures. So where do these come from? From here. From here. Which means we maintain the net cash flow but change the discount factor, which is based on 20%, and then we recalculate. So when you recalculate, you're going to get a different set of figures. So now the NPV for machine A is 7,937, and it's negative 10,317 for machine B. So we put that into the formula, okay? For machine A, small a plus capital A over capital A minus capital B times small b minus small a. So you'll get 24.02%. Okay. Doing the same for machine B, small a plus capital A over capital A minus capital B. Remember, capital B is negative. So negative, negative, that's how it becomes positive here. Times, that's the typo over here. Small b minus small a. So we get 15.1%. So now, which is a better project? Okay, so now when you want to decide on IRR, if the project's cost of capital, if let's say your IRR is say 20%, for example, and the project's cost of capital is less than the IRR that we calculate, then we should accept the project. So this IRR idea is like a break-even point, because anything less than the interest rate here to the left, you'll see the NPV, the line is above the x-axis. You understand? So if a project's cost of capital is lower than the IRR that we calculated, that means the project is good. We accept the project. But if the project's cost of capital is more than the IRR that we calculate, as in the interest rate is more than the IRR that we calculate, then we should reject the project. So in this case, the project's cost of capital is 10%. And the IRR for machine A is 24%. Right? So, which means if you compare 10 and 24, it's like there's more profit there. But that means 10 is closer to 15.1 as compared to 24. Yeah. So the further away the cost of capital is from the IRR, the better it is. Further away, and it must be lesser than the IRR. Okay. So here's the answer. So state which machine CLAC should purchase. Okay, so now questions will ask you this. They'll make you calculate using the different methods and ask you which investment is a better one. So when you compare machine A and machine B, CLAC in this case should choose machine A, because when you use the ARR method, A produces a higher rate of return. So using the ARR method, A is better than B. Using the payback period method, A is also better than B. Okay. And using the NPV, A is still better than B. So that's what they're trying to say here. Okay. And using the IRR, A is 24%, which is further away from the cost of capital of 10%. It's a difference of 14%. Whereas B is just a difference of 5%. Of course, both projects based on the IRR is acceptable, but here you get a more profit as compared to here. So decision is to choose machine A. Suggest why CLAC requires the new machine to produce an IRR of at least 22% if it already produces a positive NPV. So this is the answer. So positive NPV suggests that expenditure may be considered subject to other conditions being favorable. Okay. But if IRR is less than the present return on capital employed of 22%, the project will dilute the present profitability. Okay. So when the profitability is diluted, that means becoming smaller, it's a reason for not carrying on with the project. All right. So IRR greater than 22% will increase profitability. Okay. So that's all on this chapter. I can go to another question, this quick one. So look at question 2. Directors of Relham Limited plan to introduce a new product. So a new machine costing 125,000 will be required. It will be sold at the end of 5 years for 30,000. So this is the scrap value. 125,000 is the capital. And this project is for 5 years. Machine depreciated using straight line method. So the new product will earn $90,000 revenue annually and incur additional expenditure of 60,000 each year. So the 90,000 per year is the initial, sorry, the what do you call annual cash inflow, and 60,000 is the annual cash outflow. So the purchase of the new machine will be financed by a loan of 8% per annum. So you can take this 8% to be like the cost of capital, because 8% is the cost of obtaining the loan from the bank to finance the purchase of the machine. Okay, so you're given the both the interest rates. So since they mentioned here 8%, to calculate NPV, you use 8% and not 14. So calculate the NPV. So we list down the receipts, payments, and the net receipts, multiply by the discount factor given based on 8%. So you get the present value, total it up, and deduct the initial investment. So you get the net present value. As you can see, it's greater than 0. Okay, so doing the same for the second machine, you will get a negative NPV. Okay, no, sorry, this part one, there's only one machine, right? So calculate the NPV. Yes, we will get 15 to 20. So in the second part, why we need to calculate NPV once more is to get the other NPV based on 14%. Okay, then we put it into the IRR formula. So we will get an IRR of 12.21%. Our current interest is 8%. So it's lesser than the IRR. So the project is acceptable. Okay, lastly, calculate the ARR. So this is the average annual profit. So how do you get the average annual profit? In this case, the annual cash inflow is the same, and the annual cash outflow is the same. So 90 minus 60 is 30. And then you're going to depreciate 125,000 over 5 years. So 125 minus 30 divided by 5. So that's going to give us 19,000. So which means the average annual profit is 90,000 minus 60,000 minus 90,000. And that's how you get 11,000. Okay. So 77,500 is the average investment. So initial value plus initial investment plus scrap value over 2. Okay, there's no working capital increase. So the ARR is 14.19%. All right. The next part of the question is on another topic. So I won't discuss that. Okay, so that's all for this video. Thank you.